What's going on, investors? AK from Fallible here, and today we are going to start our series on cognitive biases. We're going to talk about the different ones, what they are, how to avoid them, all so you can be a more profitable trader. And today's video, we're going to start with recency bias. So if you remember in my last video, I talked about how our evolutionary biology has made us horrible traders. We got our emotions running wild, we got a real strong need to fit in with everybody. And I mean, you can't blame us, it comes from Ugg and Grog running into mountain lions that wanted to eat them. And then if Ugg didn't like Grog and kicked Grog out of the group, then he would go die in the wilderness. He needed his group, he had to fit in. So it's not our fault, which is nice because who likes taking responsibility? But I guess even if we weren't the cause, we do have to deal with the result. So another thing that our evolutionary biology made us into is lazy. Now I wrote an article about this on Macro Ops called Avoiding Cognitive Biases in Trading. I'll link to it below. So I talk about back in the day how we were faced with cycles of feast and famine. So we'd have short periods of feeding with long periods of sustenance living. You know, you'd kill a boar and feast on that boar. Everybody was real happy for a day, and then you'd starve the rest of the time. So naturally, we evolved to conserve our energy as much as possible. So given two options, we're conditioned to choose the one that involves the least amount of effort. And that doesn't just go for physical activities, but it goes for mental functions as well. Because it turns out the brain consumes 20% of the body's total energy. 20%, which is more than any other organ. So we're always going to go for the quick and easy solution over the tough one, which requires more thinking. And that's true even if the easy option is wrong. So to help with the low effort decision making, we've developed heuristics. So heuristics are quick and simple rules that we use to easily form judgments and opinions. They're mental shortcuts that slice through complexity. So even though these heuristics work well most of the time, like if someone's carrying a knife towards you, you can probably assume that they're going to try and hurt you, as opposed to trying to really think about it and be like, oh, are they about to go cut vegetables? Or no, because if someone has a knife and coming at you, you got to get away. It's that quick thinking, no complexity. But when it comes to things like trading, this quick thinking can really work against you. And that's where the cognitive biases come into play. So one of these biases is recency bias, which is believing what occurred in the recent past will continue to occur in the future. Now this goes for the opposite too, which would be believing that because something hasn't happened in a long time, it will continue not to happen. So if where you live, the last time you guys had an earthquake was in 1950, most of the people living there are thinking, you know, we never have earthquakes, that'll never happen again. When in fact it can. So say you flip a coin and get heads 5 times in a row. If that happens, you'll naturally start to think that the 6th flip will probably be heads too, because heads is the trend. But in reality, you'd be wrong. And that's what recency bias is, because you're letting the past outcomes incorrectly influence what the future outcomes might be. Because when it comes to a coin flip, no matter what happened in the past, the probability is exactly 50% of whether you're going to get heads and tails for the next flip. So think about how this affects you as an investor. So for example, the buy the dip mentality that worked great since 2009. So people got shaken out of that a little bit in 2018, but so far it's sort of continued to work. But does that mean it's going to work forever? No. And a lot of investors that continue to do that are going to get blown out, but they'll continue to do it because they think, okay, if it worked in the past, it should keep working. And what's funny is that the past is only the last, 10 years? That's not even a good sample, because right before that, we had a huge financial crisis, and just 8 years before that, another market crash. So really, it's recency bias in two ways. Thinking what already happened is going to continue happening, and then when evaluating data, only going back a smaller period of time, or just looking at recent data. So the easiest way to avoid this is just to stick to your trading plan, because if you have the right trading plan in place, then you've already back tested what you're doing to see if it works, and you have the expected value figured out. So that'll help you keep executing and not get influenced by whatever the recent results were, because you're looking at the full cycle. Now here's something funny. I personally trade a momentum strategy, which means that I kind of take advantage of the recency bias, because you know what momentum is, right? If something is moving strongly in one direction, it should continue to do so, which technically would be recency bias, but I think it's more of taking advantage of others' recency bias. So if all these investors see a stock is moving up, they're going to put more money into it, because the stock moving up is signaling it's a good stock, which means they should buy it, which in turn their buying pushes it up higher. And markets are reflexive, so they're thinking it's a good stock makes it a good stock. But when I'm using a strategy like momentum, I know it's back tested, so I know it works because it's robust. It's not something like buy the dip that's going to get completely crushed in just a different cycle. Momentum has been shown to work across hundreds of years. So there are strategies you can use to take advantage of other investors' biases, and a momentum strategy is just one way to do that. Now, if you need help getting over your trading biases or your other trading emotions, then make sure you check out my Fomo trading guide. It teaches you how to avoid feeling FOMO in the market, but it also gives you tips and tricks that you can use for really any emotion or bias. I refer to it all the time. Just click that link in this video or down below, go to the page where you can enter your email and I'll send it over to you. to you is free. And if you haven't already, make sure you subscribe to this channel and hit that bell for email notifications of new videos. We publish videos every day, all market and business related. So subscribe, and I'll see you in the next video. Stay fallible out there. Bye.